Hi, I'm Dan Jessen. Today I'll be presenting a Giving Voice to Values case titled The North Face Incorporated. The North Face is a popular apparel company based in San Francisco. You may have seen their products in stores and being used and worn by people that you know. It is a manufacturer that makes and retails really cool outdoor clothing and camping gear like sleeping bags and things of that nature. North Face had a CFO named Christopher Crawford and a vice president of sales named Todd Katz. Management had set an aggressive strategy to hit high levels of annual sales volumes, and their salaries and bonuses were tied to the results. Well, in 1997, it was becoming harder and harder to hit their lofty goals on which their bonuses were based. Does the fraud triangle sound familiar? Because these two guys were starting to really feel the pressure to act unethically in order to hit their bonuses. Basically, what happened was, in the end of 1997, when they needed to hit their annual goal, they had a bright idea. They decided to enter into a barter transaction with another company, which we'll call the barter company. Basically, North Face would give the barter company a whole bunch of North Face products to sell in the future. The barter company would then sell the products and give back some cash and some trade credits to North Face when the products sold. Et voila! 1997 sales goals met and bonuses paid. Here's the deal. The value of the transaction was about $7.8 million. Only there was a problem. GAAP. GAAP would not allow them to book the trade credits as revenue. So say goodbye to those bonuses, boys, unless you start to get creative. So what they decided to do was to split the transaction between two reporting periods and make the credit amount below the materiality amount that the auditors would look for. Even if Deloitte catches it, you can still pressure them to ignore it because it's below the materiality amount. So now we have the opportunity, the second leg of the fraud triangle. Basically, instead of doing one transaction for $7.8 million, we talk to the company and we say, let's do a nod, wink, wink deal with the barter company. We'll split the transaction into two separate transactions on paper and pretend as though that they're not related. One transaction will occur in the final days of 1997, and it will include all of the cash and part of the trade credits. The other one will happen in 1998, and it will be composed of just trade credits. And everybody will pretend as though they're two separate transactions. Well, after you figure the net profit of the trade credit, it was worth $800,000. Materiality for net profit was set at approximately $1 million. And the CFO knew that, and that's why he designed the deal exactly the way he did. Deloitte, sure enough, became aware of the 1997 problem and said, you can't book the $800,000 as a journal entry. However, they were convinced by the CFO to ignore it due to it being immaterial, despite the fact that his bonus was tied to net profits. So the CFO and the vice president of sales lied, both through direct commission of lies and through omission throughout the whole process. The same problem arose in the 98 audit. But Deloitte was convinced to ignore it, using some of the same bad internal communication and rationale and logic between the auditors. They really shouldn't have allowed the 98 to not be adjusted, but they did. Of course, the CFO is telling them, come on guys, not only is it immaterial, but it's like this. It's not like the sale didn't happen. We did this transaction and there was a value paid there. It's just a minor GAAP rule that you shouldn't allow us to be able to take care of this. Now we have the rationalization, the final leg of the fraud triangle. In summary, bonuses were tied to the fraudulent non-application of GAAP, which provided the incentive to cheat. Even if it was immaterial, the result was clearly to misstate profits for personal gain. Deloitte's auditors should have insisted on a journal entry in both years to disallow the trade credits as revenue. Auditors must consider key decisions made by management in the context of their decisions and their motivations. And in the end, guess what? Those sales didn't happen and the company had to re-buy back the product. And so they had stated revenue and profits that ended up never happening. Therefore, the quality of this audit by Deloitte has to be given an F. Thank you for your time.